Market attention is closely concentrated back in the 44s, at the upper boundaries of a bearish reversal range, where the main formation is a head and shoulders. Elements of double and triple tops were also present. The chart was holding neutral overall towards the end of November, as resistance from the 44s didn't even significantly lower AAL prior to the gap up. As usual, the gap up and fill ranges are of interest now. It is shaping up to be a strong gap up, as shown by the higher highs of each downswing point, and the firm lower boundary of the gap up range, directly taken from the open and close prices of the gap up candle. In the short to medium term, this gap up range still provides firm support to counter regular short-term spikes in selling. The gap up range has been strong, but shorter-term price action in the past week does see it possibly coming to an end. That is why the prior 44 range is still relevant. In the case the gap is filled. Similar to other examples, an old range is reused. The 44 range went from resistance at the top of a head and shoulders to a very accurate gap up range that naturally crosses near open, high, low, and close prices of the candles just before the gap. The wait continues as the 47 gap up price holds. A minor upswing that is relatively weak in both price action and volume. The gap ranges are still very much in the spotlight of all time horizons until the mid-50s can be decisively passed. It is not an overly strong bearish situation yet, but a drop back towards the 44s can easily materialize with some increased selling volume helped by a stable downtrend. Naturally, strong support will still persist from the strong 47 gap up open price range. In the medium to long-term view, it is clear the gap up range is the neckline range of a plausible head and shoulders, and the supporting base of a potential descending triangle. Bearish background was present, but market sentiment in mid-March did not increase to significantly bearish levels at a key time nearing the end of the two aforementioned potential bearish reversal patterns. Instead, the exact opposite occurred with a strong bullish surge to gradually break over all the descending trend lines to negate the potential bearish patterns. Despite the bullish surge, it is not out of the ordinary to have a less strict double top form. At 55.70, the site of the previous major highs. The drop is strong in terms of the steepness, but the volume is comparatively weaker at normal to slightly below normal levels. So it is more of a bullish overextension undergoing a correction after a steep and unsustainable incline. On the way down, there is expected support from the gap up fill from mid-March. And now, the main focus of market attention returns to see how the gap up range near the 47 level supports falling price. A very literal sense of the word reversal. The short-term downtrend has been reversed after a mostly indecisive April at the gap up range. Naturally, the old descending trend line and the 51.75 level still have a residual influence, but it is weak overall, especially as it takes place in front of increasing bullish sentiment. Unlike the downtrend, this is strength in terms of steep bullish price action and increasing bullish volume. Although there was strong bullish context approaching 51.75, it was no guarantee of an indefinite uptrend. This was especially true as there was immediate bearish price action and volume, following the longer upper wicked candle on April 24th. A definite horizontal range formed after the less strict double top. And now the medium-term balance is a bearish advantage. The recent upswing off the still important 47 gap up level has been relatively weak in terms of volume and price action, in the face of multiple downtrend lines and resistance levels that remain influential. Many weeks have passed, and the bearish acceleration has finally arrived to fill in the gap. This was such a strong drop, the large red candle didn't even slow down at the crucial 44 range. Naturally, the next major lower boundary was the neckline area around 39.30. As this holds for a potential triple bottom, the downtrend lines will be helpful in gauging the strength of any bullish reversal developments. The downtrend lines lose influence, and while there is no immediate uptrend, there is the secondary effect of the market moving more range-bound after the downtrend lines were breached and lost influence. It is a clear failed triple bottom now, and in the event the 44 range can't be cleared soon for a flat bottom, the current range can be the resting phase in a long-term downward continuation. Overall, this example had the gap up as the focal point of attention, and the less strict double top, head and shoulders in a horizontal range, and descending triangle were additional formations to take into account. AAL continues the drop and slides down on the influence of the past downtrend lines, but makes a recovery later on. During the trip back up, the prior ranges are helpful in determining resistance and trading ranges. When a peak forms in early 2018, in the mid to upper 50s, there is a great example of a minor gap downfill that marks a significant bearish landmark in the downtrend that follows.